Hello, welcome if you are new to this channel. In this video we will talk about dividends. Let's see what they are, their advantages and disadvantages, some key concepts, and finally learn how to see whether or not the dividends paid by a company are safe. What are dividends? Dividends are part of a company's profits that are distributed to shareholders, may be distributed periodically or on one-off occasions. Advantages and disadvantages. The main advantage of dividends is the possibility that gives the shareholder to receive proceeds without having to sell their stake in the company. If we reinvest this money, in the following period we will receive more dividends, which will allow us to buy even more shares, which will generate even more dividends to follow, and thus generates a snowball effect. Another characteristic of dividends is that they consume free cash flow. If a company distributes all the money it generates, then it no longer has money to invest, which can affect its growth. In addition to investments, free cash flow also gives the company the possibility to cut down debt and repurchase shares, and this is no longer possible if dividends consume the vast majority of the company's balance. One of the main disadvantages of dividends is that they are tax inefficient. The money used by the company to pay dividends has already been taxed at the corporate level. Once distributed, the shareholder may have to repay taxes on them, and so there is double taxation. Key concepts about dividends. Taxa de dividendos is the return of the dividends. We can calculate this by dividing the dividend received per share by the share price. Total de dividendos pagos pela empresa. We can calculate the total of dividends paid by a company by multiplying the dividend yield by its market capitalization. Payout ratio is the fraction of net income a firm pays to its stockholders in dividends. Now that we realize what dividends are and we know their main characteristics, we will finally learn how to calculate whether the dividends distributed by a company are safe or not. Many investors love stocks that pay a high dividend rate, so several companies increase their dividends to attract investors. However, it is necessary to understand if the company can afford them in a sustainable way, and for this we can use the free cash flow average. The idea will be to calculate the total amount of dividends paid by a company annually, and then compare this amount to the average free cash flow of the last 5 years. If dividends represent, for example, 200% of this average, we can immediately ask ourselves if the company can sustain this dividend rate much longer. I like that this value remains below 100%, and that on a portion of the free cash flow for the company can shoot down debt, repurchase shares, and make acquisitions of other businesses. Let's go to an example. Coca Cola has a current dividend yield of 3.08%. If we multiply this value by its current market capitalization, we see that it pays a total of $8 billion annually in dividends. Comparing this value with the average free cash flow of the last 5 years, we see that dividends consume most of it, which may not be ideal. Of course, this varies from company to company. For example, in larger companies, which have less opportunity for growth, it is more interesting to distribute dividends than in an embryonic company, which will be more appropriate to use the available capital to reinvest in the business and make it grow. As attractive as they may seem, buying a stock just to receive dividends, in my opinion, it's like buying a cake just to eat the cherry that comes on top. I hope you enjoyed this video. The numbers used are rounded values, and the opinions given are just my personal perspective. It is not a recommendation. Leave suggestions in the comments of financial indicators that you would like to be covered in the next videos. Thanks for watching and good business.